Is the retail sector poised for a resurgence? With a $150 million investment on the horizon, it might just be. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Front Range Capital Partners has teamed up with O'Connor Capital Partners to launch a $150 million programmatic joint venture aimed at developing triple net leased retail assets along the East Coast. This collaboration is backed by a fund managed by Front Range, with the sole limited partner being one of the largest university endowments in the United States. The venture plans to develop between 12 to 15 triple net leased retail properties in strategic East Coast markets. O'Connor Capital Partners, a fully integrated real estate investment and development firm based in New York, will spearhead the site acquisition, development, and leasing efforts. Meanwhile, Front Range will handle asset management for the investment vehicle. These properties are set to be leased on a triple net basis to nationally recognized retail tenants, creating long-term income-generating assets. David Robertson of Front Range expressed enthusiasm about the venture, noting that it combines world-class tenants, a top-tier development partner, and long-term institutional capital. This initiative not only highlights the potential for growth in the retail sector, but also underscores the strategic importance of collaboration between major real estate entities to drive development and generate income. The Florida legislature has made a significant move by passing House Bill 7031, which, pending the governor's signature, would repeal the state's sales tax on commercial real property leases. Historically, Florida has been one of the few states to impose a sales tax on such leases, with the current state tax rate standing at 2%, down from the general 6% sales tax rate on other items. When local option tax rates are added, the combined tax rate ranges between 3 and 3.5%. This new bill proposes to eliminate these taxes entirely, rather than reducing them further, marking a substantial shift in the tax landscape for commercial leases in Florida. The repeal of the sales tax is scheduled to take effect on October 1, 2025. However, it's crucial to note that the tax applies to the period of occupancy. Therefore, if rent for October or any subsequent period is prepaid before the effective date, sales tax will not be due. Despite this, certain real property rentals will remain taxable. For instance, short-term residential rentals, vehicle parking, boat docking, and aircraft hangar rentals are still subject to tax, as the budget agreement only repeals Section 212.031 of the Florida statutes. This does not affect the separate statute under which these other rentals are taxed. It is important for commercial property owners and lessors to remember that the tax will still be due for occupancy periods prior to October 1, 2025. For instance, if a tenant is behind on rent for months preceding the repeal date, any payments made after the effective date for those periods will still incur sales tax. The same applies to rental adjustments related to pre-October 1st occupancy periods, such as additional rent due to increased property taxes. Despite the repeal, successor liability remains a concern. Purchasers of commercial real property need to be aware of potential successor liability for the seller's sales tax obligations. The Department of Revenue has a 3-year window from the time a sales tax return is filed to audit and assess any deficiencies. To mitigate this risk, a purchaser can require the seller to obtain a certificate of compliance from the Department of Revenue. However, if the seller ceases filing sales tax returns, obtaining this certificate might be difficult. Therefore, it may be wise for sellers to continue filing sales tax returns post-repeal, even if no tax is due, to ensure they can request a certificate of compliance. Additionally, it should be noted that equipment rentals remain taxable. If a property owner leases equipment to a tenant, such as a forklift in a warehouse, the rental of this tangible personal property will still be subject to sales tax. This distinction is important for property owners to consider when structuring their lease agreements. San Francisco's office market has experienced a notable change, as reported by Sarah Clearman. In the second quarter, the office vacancy rate in San Francisco saw a decline, and the driving force behind this positive shift is attributed to advancements in artificial intelligence technologies. This development suggests that AI is playing a critical role in reshaping the commercial real estate landscape, especially in urban centers like San Francisco. The integration of artificial intelligence has allowed companies to optimize operations and reduce costs, leading to an increased demand for office spaces. This is a promising sign for the commercial real estate market, which has faced challenges in recent years due to various factors, including the pandemic and the rise of remote work. While San Francisco is experiencing this positive trend, it raises the question of whether similar patterns could emerge in other tech hubs, such as Kitchener-Waterloo, London, and Cambridge in Ontario, Canada. These regions are known for their strong tech presence and innovation, and the adoption of AI could potentially influence their office markets as well. In the United States, the resurgence in office space demand driven by AI might also serve as a valuable case study for Canadian markets. It highlights the cross-border relevance of technological advancements in commercial real estate, offering insights into how regions can adapt to these changes and capitalize on new opportunities. As the commercial real estate sector continues to evolve, it's crucial for stakeholders to stay informed about these developments. The impact of artificial intelligence on office spaces is just one of many factors shaping the future of real estate, and understanding these dynamics can help businesses and investors make strategic decisions. Dallas-Fort Worth Real Estate Investment and Development Group, DFW LAND, has recently acquired 112 acres of land in Celina for a groundbreaking $250 million mixed-use project. The land, purchased from the Choate family, is strategically located at the intersection of the Collin County Outer Loop and Preston Road. Vijay Bora of DFW LAND, while keeping the purchase price under wraps, announced the ambitious development plans. Davidson Bogle Real Estate has been enlisted to attract potential retail, medical, hospitality, and office users to the site. Additionally, the development may feature apartment units, with a grocery store likely serving as the project's anchor. Bora shared that design efforts are currently in progress, with the possibility of breaking ground as early as next year. Talks with a major tenant are already underway, though Bora did not divulge further details. This development is situated in a prime location in Celina, adjacent to a Walmart Supercenter anchored project and a forthcoming HEB development. The transaction was facilitated by David Davidson Jr. and his father, David Davidson Sr. The Choates, the sellers, are longtime Collin County residents with roots dating back to the 1850s. They are historically known for their Choate family pharmacy, which gained notoriety when outlaw Clyde Barrow mistakenly broke into it in 1932. Celina continues to be one of the fastest-growing cities in the United States, with its population nearing 52,000, according to the latest U.S. Census estimates. Over the past year, the city has experienced an impressive growth rate of 18.2%, ranking fourth among towns and cities with populations exceeding 20,000. Vijay Bora expressed his vision to create a state-of-the-art commercial center that will serve as a new hub for the area. In an exciting development for the West Valley, a new industrial park in Goodyear is set to blend work and play. According to Haley Mensick of the Phoenix Business Journal, this innovative project will feature a pickleball court and a putting green, adding recreational amenities to the industrial landscape. Once fully built out, the park will also include a 63-acre retail component, promising to enhance the area's commercial appeal. Lincoln Property Company is at the helm of this ambitious project, which aims to create a dynamic environment where work and leisure coexist. This approach reflects a growing trend in industrial developments, where amenities are incorporated to improve the quality of life for workers and make the sites more attractive to potential tenants. This development highlights a shift in industrial real estate, emphasizing the importance of creating spaces that cater to both professional and personal needs. As the industrial sector continues to evolve, incorporating elements like recreational facilities and retail spaces can be a key differentiator for attracting businesses and employees alike. The inclusion of a significant retail component further underscores the potential for this industrial park to become a central hub in Goodyear. With retail spaces planned alongside the industrial facilities, the project is poised to bring increased economic activity and job opportunities to the West Valley. As we see these types of developments gaining traction in the United States, it poses an interesting question for Canadian markets, particularly in regions like Kitchener-Waterloo, London, and Cambridge in Ontario. Could similar mixed-use industrial projects emerge in these areas, offering a blend of work and retail opportunities? Only time will tell, but the potential for cross-border influence is certainly there. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.